So in today's teaching, we are going to continue from where we stopped on technical analysis. So we have talked about liquidity and all of those fun stuffs, right? So today we are going to talk properly about the concept of fair value gaps, right? So we have to understand fair value gaps properly, right? So I know that some of you guys have seen screenshots of fair value gaps, people using fair value gaps, and all of that. All right. So I'll be teaching you guys the three kinds of fair value gaps that I use and the importance of it. So welcome to this session. Today is the 10th day of the training. We are almost halfway, right? And I want to really appreciate you guys for your time, because time is the most important part of a man's life, right? You can recover everything else, but you can't recover time, right? So thank you guys for your time, and I hope you're getting some value. All right, so now let's understand what fair value gaps are. So a fair value gap can, it looks this way. I don't know how to define it, but it looks this way. So ideally, you would find three candles. You see the first candle, all right? See the first candle, print is higher and is low. Then you would find the next candle, print, right? And then, this candle also forms what is high and low. And now you have the high and low of the next candle, and then you'll find what another candle here. So a fair value gaps requires three candles to print. So that's the first thing you must understand, that it requires three candles to print. So you see your third candle here. This is the high of the candle, and that is the low of the candle. All right. So look at this. A fair value gap prints when there is a gap, like the name implies, between two candles. What do I mean? If you look at this candle here, you notice that the wick of this candle ended here, while the high of this candle ended here. That means in between this space and this space, there was no buy order. Understand this. This candle was dropping, and then when it came to this level here, it shifted up. So let us mark that level so you can understand it. So as price came to this level here, price pushed up for a buy, and then it retraced and then dropped down. So in this place again, market did the same thing. It pushed up and then dropped down. So you can see that there was some buy momentum inside here, a little buy momentum, and the market was sold aggressively, and then a little buy momentum again, market was sold aggressively. So we can say that the buy momentum happened from here and here, and then another buy momentum occurred from here to here. But inside this space, like inside this candle, we saw only what? Sells. The market just dropped off. So now the distance between where the buy stopped, right? The distance between where the buy started here and where the buy stopped, this gap, like this space here, where the market did not overlap, right? Is what we call a fair value gap. So if this candle was, let's assume maybe this candle this week was able to reach here. That means we can say, okay, this candle is properly balanced, right? If the week was able to reach here, we will say, okay, the candle is properly balanced. You understand that? So now, in cases where the candle does not overlap with the wick of the first candle, we call this what? A fair value gap. This simply means that there is what? A gap or an imbalance or an inefficiency. So the other words for fair value gaps are imbalance or inefficiency. So because some people call it imbalance. So how does that back of it? Someone say imbalance, the person is still referring to the same thing. The person say inefficiency. Someone say IPA, imbalance price action, is still the same thing. So these are all the words that you can use to refer to what? This single what? Phenomenon, right? So this single phenomenon is what we refer to as what? Imbalance, fair value gap, inefficiency, or what? Imbalanced price action, right? IPA, or inefficient price action. So that means that there is what? A lack of what? Buy orders inside it. So we now expect price to in the future, we expect price in the future to do what? To come back to what? Balance what was not balanced. So possibly the next candle can open now, and then you see market was come up to fill this imbalance before dropping down. So this is not be your area of interest, this gap between this high and this. So price can maybe come to fill it, or maybe tap into it a bit and then fill halfway and then drop off. Right. So that is what we refer to as a fair value gap. Now, a fair value gap acts, or let's say it fulfills two purposes. Number one, it acts as a higher time frame with key level. Right? It has a higher time frame key level. Right? It acts as a point where you want to take your trades from. It acts as a point of interest or area of interest, right? It acts as a POI where you can take a trade off or where you expect price to come to, and then finally it acts as a draw on liquidity. Price is drawn to imbalances, right? So you can use this as what? A higher time frame key level. That means if you're looking for a sell continuation, you can use this as your area of interest or your key level. And you can also use imbalance as a drawn liquidity. Don't want to explain that. So now, when we talk about drawn liquidity, we can use imbalance as a place where we expect price to go to. So for instance, now assuming that maybe I was buying the market down here, so I can be buying to what target this imbalance as what my drawn liquidity. So it's not acting as an area of take profit. So maybe if I was buying this market down here, right, and market was coming up all the way, I was buying market down here, and then I was targeting what this imbalance was my target. So you can use this as what your draw liquidity. So I can buy it and then target what this the high of this candle, which is what the open of the imbalance, as my draw on what liquidity. So the right way for me, the way I denote imbalances is by using this parallel channel. So I usually do it this way. So that's my imbalance from there, this point. So it helps you to mark the middle of the imbalance. So as I mark my imbalances, so I mark it this way with this tool. This middle one is the 50% of the imbalance. So I have to know where the 50% of the imbalance is. So I use a parallel channel to mark my imbalances for me. Some people use boxes like rectangle shapes, all those shape tools. But some people use lines too. Some people use lines to mark it. So anyhow you do it is correct. If you want to use lines, like I did, what I mean, if you want to use lines like this, you're correct. If you want to use this, you're still correct. So however you feel like you want to mark your imbalance, you're not far from being correct, right? So however you choose to mark your imbalance, you're not far from being correct, all right? So that is how to do it. So can you use it as a high time key level, a point of interest, that means where you want to expect price to react from, or a key draw on what's liquidity. So now we have various kinds of imbalances, and I'll just quickly talk about them. All right, so we have kinds. So we have what we call the the normal fair value gap. We have the inverted fair value gap, and then I have what? The balanced price range. So these are the three kinds of imbalances that we have. Right, three kinds of imbalances. So we have the balanced price range, the inverted fair value gap, and now the original fair value gap. Now, inverted fair value gap is very, very easy. Right, this second one here, inverted. Let's talk about inverted fair value gap. So inverted fair value gap is very, very easy. It simply means that, like now, as the market formed this is what we call a bearish imbalance, right? It's bearish because it was sending price down and it's above price, right? This is a bearish imbalance, right? So this is a bearish fair value gap. We have bullish and bearish, right? So this is a bearish fair value gap, right? Because why? Market is bearish, and then this gap is what supposed to act as what a key level to continue price moving what downwards. All right. So now an inverted fair value gap occurs, or it appears when the market breaches an old fair value gap. What do I mean? Now, for instance, I mean the market is able to breach this imbalance and then comes back to tap in the future. So now it's like a break and retest, right? It's like a break and retest. When the market is able to break through a fair value gap and it wants to return back to that fair value gap, this now becomes what? It's no more a bullish gap again. It now becomes what? It's not like a bearish gap. It now becomes what? A bullish inverted fair value gap, right? It now becomes what? A bullish inverted fair value gap. So can you see that? Bullish inverted, because why? The market, it was previously a bearish fair value gap, but now market has been able to break through it, right? There's a breach. Market has able to close above it, and then it's now also retest that fair value gap. That becomes what? An inverted fair value gap. It's what we call an inverted fair value gap, right? Now, for the last one, which is what? A balanced price range. That is also very simple as well. I'll show you guys the examples for each one. So for a balanced price range, this is not the one I'm talking about. All right. So but for a balanced price range, for a balanced price range, that is when we have overlap. That means you see two fair value gap overlapping. For instance, now, okay. Now let's assume we have this imbalance here now, right? And then in the future, we'll not create another one. And maybe we'll create another fair value gap around there too. In the future now, we create another fair value gap around there. So let's assume maybe this one now. So maybe we create another fair value gap here. Right, we will create another fair value gap here in the future. Now we have what? Another gap between this candle low and that candle high. So refer to this phenomenon as what? A balanced price range. That means you're seeing a gap to the left and to the right. So there are now two fair value gaps printed here, right? Two fair value gaps printed. All right, so this was called an inverted, a balanced price range. Price greater than imbalance to the left and also to the right, and they're overlapping. So this imbalance to the right is not overlapping with what? The one at the left. So it's like a double imbalance, an imbalance at the right and then an imbalance at the left, right? I think I don't think I did this incorrectly. So I think this one's supposed to be okay, still correct. But in most times, it's usually a bullish one. It's usually a bullish and a bearish. So this one was a bearish gap originally. So most times it forms in a bullish format. So let me just quickly correct that at once. Let me correct that so it's very accurate. So in this example, most times it forms this way. Let me take this off. So most times it forms the other way around. So you see the markets, bring the fair value gap to the upside, right, instead of down. So now it usually occurs this way. Right, it creates a bullish fair value gap just there. So you have the candles high, then you have this candles low. So the distance between this is what we call the fair value gap. So we see a kind of gap printing between that candle high and this candle low. Right, so that's your fair value gap here between these two, this gap between the high of this candle and the high and the low of this candle. Right, so they are overlapping. So you don't have two fair value gaps around each other. So you have a bullish and a bearish fair value gap around each other. So now we can see that this now because of a balanced price range, because you're having this gap at the left and then have this one at the right too. So this also refers to what a balanced price range. Right. So let's take it back. This is a bearish one. This is a bearish gap. Right. Assuming that price did not break through. Right. So this is what we call a bearish fair value gap. Right, so now we have a bearish gap that is overlapping with a bullish fair value gap. So let's take this off as well. So now price made this imbalance and then maybe it was able to breach in future, and then you now have what? A bullish gap that's overlapping with what this. So refer to this as what? A balanced price range, because there is a bullish gap at the right and then a bearish gap at the left. So we call it a balanced price range. And price always reacts from there, right? It gives a reaction. Sometimes it breaks through, but usually we'll see a sharp reaction on that. All right, and then finally I want to add this. So you can also use a fair value gap as what a lower time frame entry. I can use it for what a lower. You can use it for lower time frame entries, right? So you can use it as your entry on the lower time frame. Right? When we go to enter a trade, you can enter what at a fair value gap, right? Maybe market makes this bullish price range, and then price start coming back there on the lower time frame. Maybe it's a lower time frame, so the markets are coming back there. So you can just simply do what? Put your buy limits at the low of the fair value gap, and then your stop loss will be somewhere. I don't know why this is like this. So you can put your entry there, and then maybe just to be conservative, you can put your stop loss below this low. All right, minus 0.6. All right, so that is basically. Let me put my stop loss minus 0.6. You can just put your stop loss just below the low of the fair value gap, which is somewhere around there. So you can put your stop loss below the low of this candle. So to be conservative, if you're trading fair value gaps as an entry, your stop loss has to be what below the low of this very last candle here. So your stop loss has to be down here, just below the low of this candle. So if you're buying a fair value gap as an entry, your stop loss has to be below this candle here, the low of this candle, like here. So you can put maybe 1 pip above, or maybe sorry, like few pips below it, just something like this. So this is the low of the candle. You can put your stop loss just around there, just maybe few points below it. So it's very important that you can take your entry at the fair value gap, right? And then your stop loss just at the low of the this candle. So this candle is your candle of interest. If you're bearish, this is your candle of interest, right? If you're bearish, if you're bullish, sorry, that's a kind of interest. Why if you're bullish, you're buying if you're looking to sell this, right? Entry has to be here, and then stop loss has to be above the high of this candle, right? But it just depends on your level of experience, right? So people can enter, let me take this off. So some people can decide to enter here, we don't want to buy now. So people can choose to sell here, right? Sell at this fair value gap and then put your stop loss just maybe above here. So it's also good. So it just depends on how you trade. Don't worry, I'll show you guys live example. So let's go to day charts now and spot these things on real time. So let's look at Euro USD. Right, so let's look at some examples of fair value gaps. It's very easy to spot, so you can always see these things. Now you can see this gap here. Can you see this big gap between the high and this low? This was an NFP move. So you can see a very clear bearish fair value gap here. So you're marking between this high or this one, between that low and what this high. So the fact as a fair value gap. Now you can see our price left this big gap. Now you can see another gap here. So the price started a bit. So you can see between this candle low and then this candle was. You can see how price came back to the fair value gap and was rejecting from it. So this is how fair value gap prints, right? You can see a bullish example here. Watch this. You can see how price came to the gap. Look at the gap here between this candle low, right? And this, you can see there. You can see that how market broke structure and then came back to the fair value gap and then what? But so this was referred as a fair value gap, right? So I'm looking for an example of a balanced price range. So this is an example of a balanced price range here. Watch this. Okay, it's not very clear. All right, I've seen it. So watch this. We had what a fair value gap at the left here. Can you see that? And then we had another gap inside it too as well. So this was referred as a balanced price range. Can you see how it overlapped? It was this gap. So I had two gaps here. I had this gap here overlapping with this gap. So I was also called what a balanced price range. Price forming two sets of fair value gap just almost at each other. All right, look at this one as well. Look at another balanced price range here between this low. Then what do we have again? We have another fair value gap here between this candle high and that candle's low. Can you see how this thing prints? You have also called a balanced price range. a balanced price range because there's two imbalances overlapping each other, right? You can see how this printed, and then you can see how price came, and then it came there, tapped there. You can see how it's pushed up a bit. The market was very bearish. It pushed up a bit, and then you can see that the rest is history. So you can always use this. So you can see inverted gap already. This was bearish. The market came and then tapped back there. It became bullish, right? So fair value gaps are very important in the market. They help you to do what? To know where price is going to react from. All right, so you can see another gap here. You can see there are many gaps here. Right, you can see how price tapped that one and then it came for this lower one too. But if I see plenty gaps overlap, I usually mark them all together. So you can see how this gap was close to this one. So I usually mark them together like this, just mark everything together. So you can see how this is print out in the market. So you can use it for your entries, you can use it for your POI. It depends on the time frame you're using it. And you can also use it for your key level, right? It's very, very beautiful. This is 30-minute charts. Let's go to a daily chart and see how this can occur on a daily. So you can see fairly gap on the daily chart as well. All right. So watch this. Market was bearish. Can see this gap. Can you see this gap inside there? So you can see how market came back, tap into that gap, and then you can see the market dropped like crazy. You can see this is a daily chart now. You can see how price came with that daily gap and then was dropped off. All right. So this it happens on repeat. Look at this bullish gap here. Right, this was internal liquidity though. You can see how price came and it was finding difficult to do to breach this imbalance, right? You can see the difficulty in breaching this imbalance right there. So can you see it? See how market came bought and then you can see the market broke down. It still came back to what this inverted gap, right? Remember this bullish gap now becomes what bearish because price broke through. So market still came back here, tapped into this same fair value and then was dropped off. All right. So this is how this thing occur, right? It occurs this like this on repeat, on repeat, on repeat, on repeat, on repeat. All right, on repeat. So you can see this as well. Can you watch this? Can you pay attention to this? Look at this gap here that overlap with all this other block. So you can see this gap here, because that price came and then filled it properly for them was giving this heavy drop. As it dropped, it did come to it came to what? This gap as it hit this gap as well. So you can see how this is occurring. And this gap was what overlapping with other block. So you can see how this other block was overlapping with other gap. So you can see this other block here was overlapping with what this fair value gap. So you can always pay attention to that. Right, this fair value gap was overlapping with this other block, and you can see how this other block too was overlapping with what fair value gap. So it's very, very high probability when you see a fair value gap that is overlapping with other block. So you can see this as well. Can you see that how this one was overlapping? So if you just understood this, other blocks that overlap with fair value gaps are what we call high probability other blocks because they give us momentum. So look at this other block as well. You can see this big gap that was overlapping with this other block here. So you can see how markets came, tapped into it, and then and all of those fun stuff, right? So you really love this when you study these things on your own. So I wish all of you can study these things on your own. That it makes sense to you. Watch this. You can see how price came there and dropped off, right? These things occur on repeats. It occurs on repeats, occurs on repeats, occurs on repeats. All right. So this is where we ending today's call. We'll see you guys tomorrow. Tomorrow we'll dive in more into other blocks and all of all this fun stuff. Right. So if you got value from this teaching, just do what to drop value in the comment section. All right. And then I'll see you guys in tomorrow's teaching. So a giveaway is loading and the giveaway will be very surprising to me. So I just want to watch you how you guys will be serious with these teachings. Right. So see you guys tomorrow. Have a wonderful day. Cheers and God bless.